This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus, Clancy, and Dianne Crocker. For the week of September 2nd to the 6th, the month kicked off with a tech sell-off led by chip makers, and investors are on edge as a new round of data adds evidence to a softening of the labor market. Multiple reports pointed to fewer job openings, hirings, and a stalling of wage growth. All eyes are now on the unemployment number to be released. And Manus, September does have a reputation for being bearish. Is that what's happening here, or is it something else?
About a month ago, we talked about the August jobs number that led to a huge sell-off. My instinct at that time was that this was a one-off data point. The reaction was an overreaction, and the sell-off was a healthy correction. I tend to be glass half full, and I felt that the July jobs number was just a one-off. That dip would come and go and be quickly forgotten. It was. And I felt good about that prognostication. Fast forward 30 days, and I'm not quite as unconcerned as I was a month ago. And I'll go down two paths with this thought. Path number one is we got a couple of data points today, Thursday, September 5th, that reinforced that weak July jobs number. The ADP jobs number came in well below expectations. The layoff report came in higher than anticipated, and people all of a sudden seem quite concerned. You can't any longer look at that jobs number last month as a one-off. We may be contracting here. This may be a bigger concern than we thought. But a bigger issue for me, and this is something you very rarely see, there was unanimity among retailers this month about their forward-looking projections. Regardless of how their earnings came in, we saw several retailers do very well with their earnings. We saw some do not so well. But almost in lockstep, whether you're talking about low-end retailer, medium retailer, department store retailer, or home improvement firm, there was unanimity in that the consumer is tapped out. And of all the data points we've seen over the last couple of weeks, that's the one that really stands out to me. Today, we got a couple more on two different parts of the market. Dick's Sporting Goods, which has been killing it for several years, became the latest retailer to say that the consumer seems to have hit a brick wall. That was unexpected, but it was of a piece. Now we have Macy's, Best Buy, Home Depot, Lowe's, all coming out and saying the same thing. And then at the lower end of the market, we got the second indication from one of the real heavy discount retailers in Dollar Tree say that they too are finding their consumers to have really slammed on the brakes. So when you put these two things together, the new data points today and the litany of retailer concerns, I've gone from being very sanguine to being a little bit less so.
The data that comes in now on a daily basis, it really does make you scratch your head, right? Is it good? Is it bad? Is it concerning? Should I be worried? Maybe it's just a blip. Maybe it's, a short-term issue. And it seemed like for every news story that's glass half full, there's another that's glass half empty. But as you just outlined, when the kind of aggregate stories start pointing the needle toward negative over positive, you definitely start to get concerned. But then I read a bullish story about Five Below, which is another discounter, which is opening stores like crazy. And I don't know if this forecast is still their most accurate, but they were predicting to open 3,500 Five Below stores by 2030. And unlike retailers like Walmart, they want live store employees who are handling checkouts. That should be a positive for the jobs market, maybe. We'll see. I also wonder as jobs numbers come out, whether folks react to it more and that the news cycle is reacting to it more, given that we're close to a presidential election and potential shifts, the administration and federal policy, and that's got people paying attention more maybe than they otherwise would.
I'd be remiss if I didn't talk about this other headline that came in over the last week or so, which was the de-inversion of the Treasury curve, that what we had been living with for several years was this inversion. And for those that don't follow the Treasury markets or the bond markets at all, inversion usually refers to when short-term interest rates are higher than long-term interest rates. And for many, many months, the inversion was very severe, 100 basis points or more at times, in which case the two-year Treasury yield was 100 basis points or more higher than the 10-year Treasury yield. That has been said to be a forward-looking indicator that a recession was coming or is coming, but it had been inverted so long that people started to say it's no longer indicative of those conditions. We've been waiting and waiting and waiting for a recession for so long. It seems like it will never come, that the soft landing will take place. We've now seen such a dramatic drop in the two-year yield that yield is now below the 10-year yield, or at least it was for a few days this week. It may be a parity today, but it does underscore when rates are falling that dramatically at the short end of the curve, people are betting on a recessionary outcome, right? That the US economy is going to slow down sharply. And that kind of underscores what the retailers have been saying.
What it's making me think as I listen to you, Manus, is at what point does the combination of the news about the retailers' reforecasts downward, US Treasury yields falling, the soft job openings, when does that start to reach such a cadence that it stirs speculation and maybe the placing of wagers that we might even see a 50 basis point interest rate cut this month?
The yield on the 10-year has been marching lower for 3 months to the great joy of people that are looking for long-term borrowing. And as of today, the 10-year was at, I think, 371, which would be 90 basis points lower than where it was 3 months ago. We were at about 460. Now we're at about 370, give or take, on the 10-year. But what was eluding me was just how much the rates had fallen in the 2 and 5 year realm. For the 5 year, we are now down, let's call it 120 basis points. And on the 2 year, we are down about the same. I would say about 120 basis points. So whereas we were once at 520 in late May, 522, something like that, we are now at 376. So 140 basis points in yield curve reduction in 3 months. So let me pause there. Let me get your thoughts and then I'll jump back in.
You know, you've seen the market root for bad news to spur the Fed to start cutting. I think now the narrative has shifted where bad news will be bad news. If the Fed does have to cut by 50 basis points, then we're in a worse place than we thought we were.
I think you're right. I think that the aggressiveness of the Fed will be the tell that indicates how much panic there is among the Fed FOMC committee, right? If they jump in and do 50 basis points, they're probably seeing data which says things are softer than we expected, which would be a real pivot from what Powell suggested only 2 or 3 weeks ago. But if there is one silver lining to this, that bad is good. You know, I said 90 basis points lower on the 10-year, 120 basis points lower on the 5-year, 140 basis points lower on the 2-year. That really is money in the pockets of people that have to refinance. And for the CRE market, at least for that sliver of the US economy, which is not a sliver, it's a big chunk, for that part of it, that's real relief for people that are facing loans that are maturing in the next couple months.
Right. And Martha, to your point, if just say that there is a 50 basis point cut and that sends a message to the market that things are worse than maybe initially, were thought, does that kill market sentiment, or are people just so happy, to your point, Manus, that, the financials are going to look a little better, that it's money in the pocket? Does it start to really fuel the engines of investment more than we would have seen with a 25 basis point cut?
We've seen 2.5 years of the markets go in two different directions as rates have gone up. There has been nary a bruise on the equity markets. People think that the US economy has been growing fast enough to offset these higher rates. They know that companies have locked in lower rates 3 or 4 years ago. We've seen record highs in the equity markets, but it has really left more than a bruise on the commercial real estate markets. We may see a reversion to the mean now, that the slowing of the US economy takes a much bigger bite out of equities for the next 6 months. And the relative winner are commercial real estate owners who see falling Treasury yields beget lower cap rates, which beget higher property values, right? I would say if I were to lay money on the table, I think that that's not out of the question. We talked about a month ago about getting salmon at Walmart. I actually passed a Dollar General today with a big sign that said, now offering fresh produce at the Dollar General. So would you get like a leafy green at the Dollar General, Martha or Dianne, or is that just, would you get your beets there, your legumes?
I might drive by.
Yeah.
Go right to the supermarket. Yeah.
Same.
Okay. Well, I didn't try it. I didn't do it. But I may have to, just to educate our audience. I may have to go there and load up on, corn on the cob and some spinach, maybe some fresh tomatoes.
You do some recon and get back.
All right. That's my homework. How's that sound?
Sounds good. And maybe they're testing the waters. Maybe they start with produce, and if that goes well, then they ramp it up to salmon, and then you could get both there.
Sockeye salmon, right? And marinated beef. Dare to dream.
That scares me.
Before we get into the Lightbox data dive, let's talk about the MBA forecast for multifamily lending and their lending projections for the rest of 2024, Dianne.
This is one I was waiting for. The Mortgage Bankers Association came out with their new reforecast for calendar year 2024, and they are predicting a 26% increase from last year's total, which was 429 billion. So a 26% increase would bring that total to 539 billion. And that is driven by, according to the MBA, the recent moderation in interest rates that they're expecting, coupled, of course, with the large volume of loans that are maturing in the upcoming quarter. So, for me, whenever there's a reforecast, I always like to go back and look at what they're reforecasting from their previous. And in this case, it was their forecast that came out of the MBA craft conference at the start of this year. And back then, MBA was predicting a 30% increase. So, to me, it was surprising in a good way that they reforecast down only a few percentage points to 26%, even though in the second quarter, loan volume was up only 3% year on year. So, that tells me, Manus and Martha, they're expecting a much stronger third quarter and fourth quarter. Obviously, they're expecting a bump from the first rate cut, whether it's 25 basis points or 50. And of course, the market's continued efforts to deal with maturities.
It does sound like their reforecast is very much of a piece consistent with what we've been saying.
Right.
The conditions are ripening for a nice end of the year. I don't deviate from that at all. I think even if we get some lousy job numbers, and even if we do have some bumps in the road with earnings from retailers in the next quarter that follow up on their dour projections that came out last week, I think that the lower rates will provide a real tailwind, and I think people will start to transact more, and it will end up loosening this wall of maturities that everybody has been so concerned about. So we and Jamie and Mike Flood and all the people at MBA are of like mind. I think we're going to see that come to pass in the remainder of the year.
Agreed. And there was another story I wanted to mention. It was a Globe Street article that showed that even outside the bank sector, that lenders on the private equity side are also jumping in and have fairly aggressive forecast plans. And the Globe Street story mentioned Avana in a joint venture with Oaktree, and they have a private equity fund valued at $25 million that they're targeting lending opportunities in a pretty broad scope. They identified 150 MSAs, and that they're hoping to double that volume to $500 million and 200 MSAs. So in the lending world, whether it's debt or equity, there is a lot of bullishness out there right now.
My bullishness or upbeatness, if you will, is limited to everything other than office. I do think that offices will continue to transact at very high levels, meaning a lot will sell. But I do think that those sales will take place at deeply, deeply discounted levels. I think that whatever activity we see coming out of the office will be largely in the foreclosure and short sale category. It will not come from people refinancing properties very often. It will be more distress driven. Everything else, I think it will be more business as usual, refinancings, property sales, and so forth. 4 out of 5 property types will improve your portfolio health, but office is not one of them.
A couple of weeks ago, we talked about the much awaited LightBox CRE Activity Index. And for those of you that are unfamiliar with that, it's an aggregate that represents a composite measure of movements across activity in appraisals, environmental due diligence, and commercial property listings. And we use it as a barometer of broad industry shifts and responses to changes in market conditions. So we had a conversation a couple weeks ago about what it might mean both month over month and year over year. And if I had a drum set, I would do a drum roll for Dianne to give us the number for August.
Based on the conversation that we've had, last week and the week before, I was really interested to see how our August index number shook out. Think back to early August, we had that big market scare, and we didn't know the impact that would have in light of all the other conflicting market barometers that came out since. So I'll cut right to the chase first. The August index number came in at 89.9. July was 92.4. And I'm going to pause there a moment to say August was only 2.5 points below July. And it's important to say only because it could have been a lot worse. August is typically a slow month. A lot of us are on vacation. It's traditionally a slower month for transactions. That stock market scare could have been a lot more impactful. It could have lasted longer. The Fed could have had to step in. We're seeing partly property listings were down from July a bit, but who's really surprised by that? If you have a property to sell and it's not a forced sale, are you going to list it before Labor Day or are you going to list it after? So I'm not, overly concerned by that. I think the number could have been a lot worse. And the fact that it wasn't really speaks to the momentum that we've been seeing in the index since March.
I think you're right, Dianne. I think that the fact that it was lower month over month is not a surprise at all. Your point about the early August swoon is an important one. But if I recall correctly, and you're the expert, I'm a tourist when it comes to the deep understanding of these numbers. It seemed like the business as usual parts of the market really soldiered on, that we didn't see much of a dip, that people were still getting appraisals done. People were continuing to do environmental due diligence. It was only in the new listings of properties that we saw a real dip. And that's what you would expect in August, right? That you would expect people, to your point, to say, why list something in the last 2 weeks of August when you can come out with a flare and list it right after Labor Day? Am I right to interpret the data this way?
That's exactly right. And even better news, Manus, you're going to love this, is when I went back and compared the August reading to August of last summer, we were 9 points above where we were 1 year ago. 9 solid points. So we're seeing much stronger velocity across the board now than we were at this time last year. The market was pretty tepid last year. It was still very frozen. We were still wondering if rates were going to go up, or down, and nobody knew what was happening. So it's really great to see that we've got that year-on-year strength. And I'm excited to see what happens in September, not just from the new listings that we expect to see coming post Labor Day, now that summer's over, and the related environmental and appraisal work that comes from that, but also obviously the impact of the first rate cut that we've been talking about already.
I'm eager to run a promotion at some point where people have to submit their year-end predictions for the December 31 Activity Index. We've had a lot of people reach out to us and ask us about the methodology and what goes into it and so forth. So there's been a lot of interest around this. It would be kind of cool that, you put in your guesses by 9:30 and the winner. What do you think, Martha? What do we have in the budget? Can we send somebody to an Italian villa for a week or something like that?
Maybe
No,
an Italian restaurant.
not Olive Garden. No, you're not suggesting that, are you?
No, definitely not.
And the
Definitely.
breadsticks are good, but beyond that, it's a hit or miss.
Did you know? It's time for our Did You Know stat of the week. And since we just talked about the activity index, it seems only logical that we cover a data point on that. We've got the historic low that was 48.2 in December of 2023, and the historic high, which was 162.2 in February of 2022, which obviously has some very specific context to what was happening in the market at that time. So Dianne, why don't you give us a refresher of what was happening?
We'll start with the historic high. So February 2022, think back to where we were then. The market was firing on all cylinders. We had record high investment activity in calendar year 2021, and we had record high lending volume. Rates, of course, were still at record lows. Everybody remembers that. And the market was just seeing crazy momentum, highs that I don't think we're going to see anytime soon. And that high in February 2022 was, guess what? It was right before the Fed stepped in and said, look, things are getting overheated. And they, of course, started their aggressive cycle of raising interest rates. And the historic low was in the more recent past in December. And that was when, after a year and a half of rate hikes and the limbo that followed that, the market was frozen. That kind of slowness in the market was combined with what is traditionally a relatively slow year end. So that's what brought the index to its low point. I don't think we'll get to those highest highs or lowest lows anytime soon. And that's I think, good news for the market.
I think you're spot on with what you said in the last sentence, that nobody should mistake, my modest bullishness about Q4 with the thought that we'll get back to February 2022. I think that was a once in a decade, once in a 2-decade type of event, which was a confluence of us being driven by zero interest rate policy, cheap money, pent up demand driven by COVID. It was a perfect storm for people to put money to work. Sadly, when you get into those euphoric periods, sometimes you have the hangover coming out of that. And the hangover in most cases is being reflected by people who use floating rate debt at the peak of the market, where valuations were high and future cash flow expectations were just incredibly overblown. Those are the ones that are still kind of wearing off that bender.
Agreed. And I'm seeing more and more forecasts that are comparing forecasts to 2019 levels, which seems prudent to me. That's a much more realistic goal to close the gap between where we are now and where we were pre-COVID.
But we talk about that hangover for a moment. We're going to get into the deals we saw this weekend, what has been selling and so forth, our regular portion of the podcast. But a couple of things that jumped out at me last week and this week were that there have been people selling properties that they bought in 2017 and 18 for really healthy profits. And it just goes to show that if you bought before that euphoria, before that COVID cheap money spike, you're probably still in a position where you can trade out with a nice return on investment. And we'll go through a couple of those momentarily. It just goes to show that if you weren't caught up in that buy and flip mentality in 2021 and 22, you're probably in a pretty good place, especially if you locked in low rate fixed and you could assign that new loan to somebody who's buying your property.
So before we get into the transactions, a couple of office trends that were noteworthy. One is good and one is not so great. So the first one is a surge in leasing that was spurred on by AI tech.
Yes, that was the real deal, if I'm remembering correctly. They had a headline this week that said there had been an aggregate 1.7 million square feet of leases signed in the Bay Area from firms that specialize in AI. That's a terrific outcome. The last 2 or 3 years, the headlines have been very negative for some of the former FANG stocks, Netflix, Amazon, Alphabet, Facebook, Google, downsizing. This is the second week in a row where we've seen an upbeat headline in the office space from a tech company. Last week, it was Amazon 2.5xing their square footage in Dallas. So a return of the big tech taking more space rather than giving space back. And this week, that headline that AI firms had been big acquirers of space in San Francisco. So let's hope that continues.
And in the not so great category, I'm going to turn that over to Dianne in the life sciences space.
Yeah, this was a story about life science buildings, which, they were highly sought after when COVID first hit. And now there's an oversupply, which is prompting some developers to repurpose them for, guess what, for office use, if you can believe it. The sector gained 59 million square feet of new space since the beginning of 2020, and another 19.1 million square feet is in the pipeline. So it'll be interesting to see. That's a real shift in the pendulum away from life science being of high interest to actually repurposing it for office, which kind of made me scratch my head a little bit.
Scratch your head. It's making me shiver. Right? If you're going to repurpose, why are you repurposing into office? That seems to be just contrary to every instinct I have. There was one other headline this week that I'll throw out there. This comes from The Real Deal. They said that New York City office leasing is on pace to top 30 million square feet for the first time in 5 years. The last time that happened in Manhattan was 2019. And if things continue on their current pace, that would happen again in 2024. And it goes to a thesis I put out there sometime in the last couple of weeks. Takers of space may be coming to this point where they're saying there may not be a better deal out there than there is now. Let's strike now before these deals go away. And what do I mean by that? If you had a loan, which was $150 million on an office, you needed to get $100 a square foot to make the numbers work. So if you were going to pay your debt, you needed that high price. It was hard to discount very much. Now that people are buying these properties at $40 million or $30 million, the new guy can afford to wait it out. He doesn't need that $100 a square foot price tag anymore. And he could say, take it or leave it. This is $60 a square foot. If you're not going to take it, I'll find somebody else that will. And maybe that's getting some people off the sidelines to say, if we hold out too long, we may miss this window of deep, deep discounts, lots of free rent, and extraordinarily generous tenant improvements.
Right. And if you're thinking long term, if you have that advantage of thinking long term, New York City will always be a draw. So I think you're probably right that the thinking is let me get in now and get a good deal and hold it and make some improvements to it and wait for the pendulum to swing back to higher office occupancy in New York City.
There's another variable here that the numbers have been all over the place over the last year or two. The predictions of what percentage of office in various cities can be converted to residential. At some times we've seen numbers in the low single digits, right? Only 5% is possible to be converted. In other times you've seen it at 10 or 15%. But there was a study that came out, and I wish I had it at the tip of my tongue. I don't, but I'll refer to it next week so that the people get credit for it, that somebody did a nationwide study where they said on average about 16%, 1 in 6 offices, have conditions that are ripe for conversion to residential. But they said in New York City, in Manhattan in particular, that number was 50%. So I pinged Bob Knackel. I wanted to get his opinion. I haven't heard back from him yet, but I'd love to get his take on this, that's an extraordinarily high number. And that may fold into this theory that it may never get any better today for tenants than it is right now, right? If we're going to take inventory off, if 25% of these offices are going to go residential and supply is going to fall, maybe these tenants are saying, let's move now before this inventory decreases by 20 or 25%. Who knows?
I think that story was published by Commercial Edge, and it might have been Yardy's information, but I recall that story as well. And it struck me as a low number nationwide.
But when you look at it nationwide, there's probably a lot of cities that don't need as much conversion, right? When you talk about places that are suffering these gluts, it's San Francisco, Chicago, Seattle, New York. Those are the ones where you have to convert. But in places, like Salt Lake City, do they need a lot of conversion? Tampa, Miami, things like that. I don't really know. So maybe when you blend it all together, maybe, it's representative of the full body of U.S. office work.
Let's zip through some of the transactions. We've got a few in multifamily, retail, and industrial. So let's hit the highlights, Manus.
Yeah, no end to the momentum in multi. I'm going to go through a couple, but I could have gone through 20. In Phoenix, the Pearl Biltmore was acquired by Covenant Capital for $152 million. That's $322K per unit. The seller was the Morgan Group, reporting there from Yield Pro. In Nashville, William Williams reports that General Services Corp has acquired The Lodge for $88 million. That's a 27% uptick from the 2017 sales price of $70 million. In Fort Collins, Colorado, the Cycle apartment sold for $120 million. That's nearly $300K per unit, reporting there from Biz West. In Chicago, the suburb Glendale Heights, the Mark apartment sold for $180K per unit. The sale there was a 32% uptick from the 2018 sale price. The buyer was Oak Residential, and the seller was FPA. That reporting comes from Cranes.
So let's wrap up with some transactions in industrial and retail.
Yes, in Lombard, Illinois, this is kind of a disappointing comp. The Yorkbrook Business Park sold for $76 million, which is a high price tag, of course, but it represented just $103 a square foot. The property is a $740K property. The buyer was Brennan Investment Group, and the seller was InvestCorp, reporting there from The Real Deal. In Fremont, CA, a more healthy comp, the property at 47020 Cato Road sold for nearly $80 million, $380 a square foot. The buyer there was KKR, and the seller was Link Logistics. It seems like KKR right now has an endless appetite for assets across a wide spectrum of property types. On Long Island, InvestCorp was a buyer in this case. They acquired a 5-property industrial portfolio, cold storage mostly in this case, for nearly $100 million. That reporting is from Globe Street. In the retail segment, Publix acquired 7 properties in Florida for $223 million. The seller there was PGIM, PGIM. That was reported by Globe Street. And I do have one more. The other one that just came out today, which I thought was a terrific one, in the Chicago suburb of Schaumburg, Woodfield Green, or I should say Woodfield Village Green, sold for $93 million. That was $221 a square foot. Reporting there from The Real Deal, which was very, very active. The reporting says that Bridge 33 Capital was the acquirer there. So a couple of nice retail stories to round out this segment.
While we are on the topic of retail, Dianne, a first of its kind concept, CBRE is pleased to offer for sale the Netflix house, which apparently is a repurposed Lord & Taylor anchor store. There's a couple. There's one in Dallas, I believe, and in Philly in the King of Prussia Mall. But the King of Prussia Mall is the one is for sale. It is a combination of dining, entertainment, immersive experience. So my question for you, Dianne, is if you were going to choose your adventure, what would it be there? Would it be Stranger Things, Bridgerton Tea, or Knives Out?
I have to say, first of all, Martha, I loved this story. I was just in the King of Prussia Mall area, and I couldn't believe how big that entire mall is at a time when people are talking about malls being a thing of the past. The fact that they're putting this gigantic Netflix entertainment center in an old Lord & Taylor dovetails nicely with the conversation we're having about high-end retail giving way to other uses. And I can't think of a better one. I would love to go to this one. I do watch Netflix. I think of those 3 choices, I'd probably go with Knives Out. That was an excellent movie, and it's kind of like a modern day Clue for those of us old enough to remember that Clue board game. We played it a lot when I was little, but Knives Out, I think, would be a really fun kind of murder mystery experience.
I have a tough time getting my arms around this image of the Netflix house. I'm not a Netflix guy. Maybe I've watched some of their shows, but I can't recall. But all that goes through my head with this image is a lazy boy farm, right? That there's 15 columns of lazy boys, and you just go in there and you put your feet up, kind of like an Alamo type movie theater where people will bring you food and you can go back and put your feet up, and I don't know, it's not striking a chord with me.
That wraps up this week. Thanks to our producer, Josh Bruning. Please join us every week as our LightBox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send us your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.